Disclaimer: the following report is for informational purposes only. It does not constitute legal, financial, or medical advice. News is news, not advice. Do not treat any anecdotal stories or commentary as guidance. Real Estate Market News Report, today. 1. Global economic and geopolitical influences on real estate. The global real estate sector is demonstrating resilience in 2026 amid evolving economic and geopolitical uncertainties. Despite a state-altering shock from the outbreak of war in Iran during the first quarter, global property markets remained stable. Economies worldwide were on a reasonably solid footing entering 2026, with inflation contained and interest rates near neutral, creating a foundation for recovery if disruptions ease. Investors have largely maintained a risk-on stance toward real estate, buoyed by robust credit market liquidity and stable asset pricing. Capital deployment is healthy, reflecting confidence that commercial real estate can weather temporary shocks and rebound as global conditions improve. Real estate investment activity is picking up across major regions after a subdued period. Global commercial property deal volumes reached $888.6 billion in 2025, a 14% year-over-year increase, with especially strong momentum in North America, volumes plus 22% YOY, and sustained growth in Europe and Asia-Pacific. This recovery follows earlier declines and suggests the market may be turning a corner, driven by improved fundamentals and stabilizing valuations. Investors are capitalizing on relative value opportunities in real estate compared to other asset classes, given that yields have repriced attractively in many property markets. While optimism is rising, industry leaders remain cautious about potential headwinds. Geopolitical risks, economic policy changes, and latent uncertainty mean a V-shaped rebound is not widely expected. Instead, a gradual recovery is anticipated, with many investors favoring patient, diversified strategies to hedge against unforeseen global events. Diversification is a prominent theme as investors seek global opportunities across geographies and asset classes to mitigate localized risks. The focus on resilience is driving interest in alternative investments like infrastructure and private credit, as over 60% of investors now view these as competitors to traditional real estate holdings. Geopolitics and oil shock. The war in Iran in early 2026 caused a spike in global oil prices. Crude temporarily exceeded $115 per barrel, adding inflationary pressure and disrupting supply chains. These events underscore how geopolitical shocks translate to higher inflation and bond yields, indirectly influencing real estate through increased borrowing costs. The oil price surge effectively neutralized prior declines in inflation, reversing some of the disinflationary progress made earlier in the year. Bond yields soared to multi-year highs. The U.S. 10-year Treasury briefly hit 4.34%, as investors demanded higher returns to offset inflation, pushing interest rates upward globally. This dynamic fed directly into higher mortgage and commercial loan rates, raising financing costs for property transactions. Notably, this was an unusual scenario in which a major conflict didn't trigger a typical flight to safety drop in yields. Instead, inflation fears dominated, causing war-related volatility to increase long-term rates. The conflict's impact on inflation and interest rates highlights how even distant geopolitical events can reverberate through global property markets via higher financing costs and shifts in investor risk sentiment. Central bank policy and interest rates. Central banks have largely paused interest rate hikes and signaled a cautious stance as 2026 begins. The U.S. Federal Reserve delivered its first rate cut in 9 months in late 2025, indicating the peak of the tightening cycle had passed. Major central banks in Europe and Asia similarly stepped back, with global interest rates near neutral levels by early 2026. This stable rate environment is broadly supportive of real estate, easing financing costs and improving investor confidence. However, policymakers remain vigilant about inflation risks, especially after the recent energy price shock, so significant additional rate cuts are not guaranteed in the near term. Markets currently anticipate only 1 or 2 modest Fed rate cuts in 2026, reflecting a cautious outlook while inflation hovers above targets. Still, rate stability itself can be beneficial. Many analysts note that a predictable, low-volatility interest rate environment encourages property transactions and development by reducing uncertainty. Indeed, as interest rates peaked and began to stabilize in late 2024, global real estate transaction volumes started growing again in early 2025 after several quarters of decline, suggesting that waning rate pressures helped unlock pent-up investment demand. Nonetheless, policy missteps remain a key risk. A sudden change in monetary direction or a resurgence of inflation could disrupt the nascent recovery, underscoring the importance of central bank decisions for the sector's outlook. Regional market divergence. Regional real estate trends are diverging as different geographies move at varying speeds. North America's property markets have led the recovery. U.S. real estate deal activity began rising again in late 2024, and property sales in the Americas were up 12% year-over-year by mid-2025. European markets, however, experienced weaker momentum, with investment volumes down 15% annually in that period amid higher bond rates and lingering economic uncertainties. Meanwhile, Asia-Pacific saw the largest decline, with sales sinking about 27% year-over-year by mid-2025 as rising interest rates and trade uncertainties weighed on investor confidence and slowed deal pipelines. These numbers highlight uneven global conditions, reflecting differences in regional economic strength and policy environments. North America benefited from relatively robust growth and ample dry powder among U.S. investors, while Europe contended with energy-driven inflation and geopolitical concerns. In Asia-Pacific, incoming capital flows shrank due to volatility in trade policy and concerns over China's economic trajectory, leading to cautious sentiment and delayed deals. Global investors are adapting accordingly, focusing on regions with stronger fundamentals. The United States remained a top target for cross-border real estate investment in 2025 to 2026, while seeking specific opportunities in emerging markets like India and stable core markets like Germany and the UK. These regional disparities underscore the need for localized strategies, with real estate outlooks heavily dependent on each region's economic conditions, interest rates, and structural factors. Capital flows and investor confidence. Investor confidence in real estate is improving, and capital flows are rebuilding as the outlook brightens. Survey data show that nearly 75% of global real estate leaders plan to increase investment in the next 12 to 18 months, citing real estate's inflation hedging potential and portfolio diversification benefits. Indeed, by late 2025, the pendulum appeared to swing. Investment returns on property assets rebounded, with a global property index up 14.1% year-over-year. exceeding general equity indices during that period. Capital markets entered 2026 in a healthy state, supported by robust liquidity in debt financing and signs of stabilization in property pricing. Many investors see real estate as a safe haven with stable yield in an environment of stock market volatility and persistent inflation, a sentiment that helped REITs and private real estate funds attract new inflows in early 2026. Moreover, falling bond yields in some regions have made real estate yields relatively attractive, prompting institutional and retail investors alike to redirect capital into property assets. However, access to capital is not uniform. Worries about higher interest rates and credit availability remain front of mind for investors, especially in markets reliant on bank lending. Overall, confidence in the sector's long-term prospects is holding, as evidenced by continued fundraising momentum and property acquisitions, even if investors are selective and focused on quality in this transitional period. Shift to private capital. Once seen as a traditional asset class dominated by large institutions, real estate's capital base is expanding and evolving. Private equity funds, family offices, and high-net-worth individuals have become increasingly prominent sources of real estate funding, both in direct property purchases and through partnerships. This shift toward more distributed capital is accelerating, creating a more agile and diversified funding environment for real estate deals worldwide. For instance, retail investors are gaining exposure via defined contribution pensions, insurance platforms, and crowdfunding, a trend that could channel trillions in household wealth into property markets by 2030. Simultaneously, financing structures are changing. Rather than solely relying on equity, developers and sponsors are increasingly tapping private debt and structured financing options, especially in markets like the U.S. where creative lending solutions have emerged to replace retreating traditional banks. Tokenization of real estate assets, using blockchain technology to fractionalize property ownership, is also moving from the fringes to mainstream adoption, with some private equity players pioneering tokenized funds and transactions. These developments point to a more fluid capital market for real estate in 2026, enabling new participants and innovative deal structures. But they also introduce new complexities regarding regulation, transparency, and investor education. Top global city markets. Real estate investors in 2026 are targeting specific cities that show robust economic fundamentals and demographic growth. According to a major industry outlook, Dallas, Fort Worth, USA, was ranked the #1 metro globally for real estate prospects in 2026, reflecting confidence in its strong job market and population inflows. Other top U.S. picks included Jersey City, Miami, Brooklyn, Houston, and Nashville, signaling investors' interest in a mix of Sun Belt and secondary markets poised for growth. In Europe, London, Paris, and major German cities like Berlin and Munich were high on the list, while in Asia-Pacific, Tokyo, Singapore, and Sydney led the rankings. These preferences highlight common themes. Investors favor markets with diverse economies, population growth, and tech or finance sector strength. They are also drawn to cities undergoing long-term demographic shifts or infrastructure booms. For example, Ho Chi Minh City and Mumbai appeared among top APAC cities as emerging investment hotspots. Such city-level strategies show that investors are adopting a microgeographic focus within regions, zeroing in on metros with strong demand drivers, even as they diversify globally to find value in a mixed recovery environment. cautious optimism prevails. Despite visible improvements, caution remains a watchword for real estate executives. The consensus is that the sector is recovering, but nobody anticipates a rapid, V-shaped rebound given lingering global uncertainties and a likely bumpy economic environment ahead. Geopolitical tensions, inflation volatility, and policy shifts are all cited as reasons to maintain a defensive strategy. Many leaders advocate patience and diversification, spreading investments across geographies, property types, and even alternative asset classes to hedge against potential setbacks. There is also an emphasis on risk management and flexibility. After the shock of inflation and rate spikes, companies are stress-testing portfolios against multiple scenarios, building resilient capital structures, and focusing on assets with enduring demand, like logistics and residential housing, to weather any storms. New economy sectors, such as data centers, life sciences facilities, and infrastructure like real estate, are particularly attractive for their growth potential and long-term relevance. Overall, the tone is cautiously optimistic. Real estate leaders are bullish but not complacent, recognizing that the backdrop is improving but still far from risk-free. 2. U.S. residential housing market trends. The U.S. housing market in 2026 is showing tentative signs of recovery, but continues to grapple with long-running supply constraints and affordability challenges. Existing home sales are inching upward from historic lows. After a nearly flat 2025, sales are projected to rise about 1.7% in 2026 to 4.13 million units. Buyer demand remains present but tempered by elevated mortgage rates and uncertain consumer confidence, resulting in one of the slowest sales paces in decades. Spring home buying season, normally robust, has been more muted as many would-be sellers and buyers remain on the sidelines awaiting more favorable conditions. However, housing economists note that underlying demographic demand, especially from younger households, is still intact and could propel the market forward once mortgage affordability improves. Home prices have been relatively stable, with only modest growth on a national basis. Median home prices are expected to rise 2.2% in 2026, on top of a 2.0% gain in 2025. These moderate price gains, smaller than the surges of the pandemic years, mean that in real, inflation-adjusted terms, home values are essentially flat or slightly down for a second year, giving buyers a bit more breathing room. Housing inventory is slowly improving. The number of homes for sale will likely grow again, by plus 8.9% in 2026 per forecasts, for the third consecutive year. Even so, supply remains about 12% below pre-2020 norms, underscoring that the market is still far from normal and total listings remain limited by the lingering effects of the pandemic-era housing shortage. The affordability picture is gradually improving, though unevenly. Mortgage rate stabilization has brought the typical share of income needed for monthly payments down to 29% in 2026, the first time since 2022 that this key metric is below the 30% threshold of affordability. With wages rising and home price growth slowing, more buyers are regaining a foothold in the market. On the other hand, housing costs remain high by historical standards, and affordability challenges persist, especially for first-time buyers and those in high-cost metros, where down payments and qualifying for loans are still difficult. This environment has sustained strong demand for rental housing, keeping apartment occupancy elevated even as rents in some regions decline. The housing recovery, while welcome, is likely to be gradual as the market works through the aftereffects of the recent affordability squeeze and supply-demand imbalances. Housing inventory and supply. Active home listings are rising for a third straight year, with active for sale inventory projected to increase plus 8.9% in 2026 year over year. This will mark the third consecutive year of inventory growth, albeit at a slowing rate as the market approaches more typical supply levels. By the end of 2026, for sale inventory is expected to remain 12% below pre-2020 norms, an improvement from a 19% deficit in 2025 and nearly 30% in 2024. As a result of these additions, the national market will average about 4.6 months of supply across the year, a roughly balanced condition, inching closer to the 6 months of supply typically considered a buyer's market. Supply conditions still vary widely by region. Some areas, especially where builders added significant new homes, have seen inventory normalizing, while others with less construction remain very tight. The continued rise in inventory is a positive sign for buyers, offering more choices and moderating bidding wars. However, the multi-year housing shortage is far from fully resolved, and total listings remain below historical levels, particularly in the most affordable price tiers. Mortgage lock-in effect and turnover. The mortgage rate lock-in effect continues to constrain housing supply and mobility, with roughly 4 out of 5 mortgage borrowers holding interest rates below 6%. Many homeowners are reluctant to sell and assume a new loan at today's higher rates. This phenomenon, a legacy of 2020-2021's ultra-low rate era, significantly reduces the number of existing homes coming to market, keeping housing turnover at historically low levels. Even as buyer demand persists, the shortage of willing sellers means existing home sales remain subdued. Indeed, 2025 and early 2026 recorded some of the slowest sales volumes in nearly 30 years. The lock-in effect particularly affects the move-up market. Owners with 3% mortgages often prefer to renovate or stay put rather than trade into a new home with a loan at 6% to 7%. As a result, the increase in new listings has been modest relative to potential demand, prolonging the inventory crunch for first-time and trade-up buyers. Unless mortgage rates decline significantly, experts predict this lock-in dynamic will continue to dampen resale supply and frustrate would-be buyers in 2026. Home sales and buyer demand. After a significant cooling in 2022 to 2023, home sales activity is slowly stabilizing. While overall transaction volumes remain low by historical standards, there are pockets of growth. New home sales have started rising as builders step in to meet unmet demand. In March 2026, new single-family home sales reached an annualized rate of 682,000, 7.4% above February and 3.3% higher than March 2025. Builders have been offering incentives and capitalizing on the lack of competition from the resale market, helping boost these numbers. Another sign of life, pending home sales, a forward-looking indicator of closings, reached their highest level since late 2022 this spring, jumping 7.7% year over year as buyer activity picked up in many markets. However, existing home sales remain weak. At 4.13 million annualized sales expected in 2026, they are still near historically low territory and well below the 2013 to 2019 average of 5.3 million annual sales. Underlying housing demand is still present, especially from millennials forming households. But many prospective buyers are waiting on the sidelines due to affordability concerns and economic uncertainty. If economic conditions improve and mortgage rates ease further, this pent-up demand could translate into a stronger rebound in sales. For now, the market's recovery path remains fragile and heavily dependent on broader economic conditions. Home price movements. Despite a dramatic tightening of monetary policy since 2022, home prices have not crashed. In fact, house values have stayed resilient and sticky in most markets. Nationally, existing home prices rose 2.0% in 2025 and are projected to increase another 2.2% in 2026, a far cry from the double-digit annual gains seen during the pandemic boom, but also far from any collapse or fire sale scenario. Because general inflation is running higher than these modest price gains, real home values are effectively declining, marking the second consecutive year of small inflation-adjusted price drops in many areas. Sellers have mostly held firm on pricing, opting to delay listing rather than accept major discounts, which has helped prevent large nominal price declines. Local market performance varies widely. However, Realtor.com's 2026 forecast sees strong price growth in some affordable Midwest and East Coast metros, e.g., Baltimore plus 8.3%, Cleveland plus 6.3%, even as certain Sunbelt markets are poised for price corrections, e.g., Cape Coral, Florida minus 10.2%, following recent overheated gains. Overall, most markets are experiencing a gradual, slight uptick in home values. But the era of rapid appreciation has clearly ebbed, replaced by a slower, more income-aligned growth trend. On the positive side, steadier prices combined with income growth could help restore some housing affordability and entice hesitant buyers back into the market, especially if mortgage rates also moderate. Housing affordability. Housing affordability remains a central concern, but there are indications of incremental improvement. Mortgage rates have steadied in the mid-6% range, and wage growth has continued, leading the typical monthly payment on a median-priced home to dip slightly as a share of income. In 2026, the average 30-year fixed mortgage rate is projected around 6.3%, down from 2025's 6.6% average, contributing to the first meaningful decline in average monthly mortgage payments since 2020. The percentage of income required for the median mortgage is expected to fall to 29.3%, a psychologically and financially important threshold, under 30%, that hasn't been achieved since 2022. Additionally, nationwide rents are leveling off or falling slightly. Realtor.com expects rent prices to decline 1% in 2026 as a wave of new apartment construction hits the market. These trends, combined with rising household incomes, are easing the affordability crunch that has plagued buyers and renters. Nevertheless, affordability hurdles persist in high-cost regions where prices and property taxes remain elevated. Many younger buyers still struggle with down payments and debt, like student loans, and racial and regional disparities in homeownership remain a challenge. Policy discussions at federal and local levels continue to focus on ways to improve affordability, from down payment assistance to zoning reforms, but results will likely play out slowly over the coming years. Renters market and multifamily housing. After several years of rapid rent increases, the rental market is undergoing a cooling and divergence in 2026. Nationally, rent growth has stalled and even reversed in many areas. Average rents are expected to decline about 1% this year, with larger drops in some markets as new supply comes online. Vacancy rates have ticked up closer to historical norms, likely to approach or exceed a 7.2% vacancy by late 2026 versus earlier historic lows, which is easing pressure on renters and moderating further rent hikes. The Sun Belt region, which saw a multifamily construction boom, is now experiencing softening rents and increased concessions due to a temporary oversupply in cities like Austin, Charlotte, and Phoenix. In contrast, coastal high-cost cities such as New York and San Francisco are seeing more stability or even an uptick in rents after prior declines, thanks to limited new construction and recovering demand. Apartment REITs report that occupancy remains high, mid-95% range, across their portfolios, supported by strong renewal rates and record-high resident retention as tenants choose to stay put rather than brave the expensive for-sale market. For renters, 2026 brings more negotiating power in many markets, and those looking to move may find better deals and more choices than in recent years, especially in newly built luxury apartments in the South and West. However, rental affordability is still strained for low-income households, and the overall U.S. shortage of affordable units persists, indicating a need for continued focus on housing solutions at that end of the market. Demographics and generational shifts. Demographic patterns are heavily influencing housing dynamics in 2026. Millennials, now at peak household formation age, are driving much of the demand for both homeownership and rentals, but face financial constraints that delay purchases. Many potential first-time buyers in their 20s and 30s confront high prices, large down payments, and elevated interest rates, causing some to remain renters longer than they would prefer. Generation Z, the next wave of first-time buyers, is moving into their 20s and expressing strong aspirations for homeownership, but financial obstacles like student debt and starter home shortages pose challenges. Gen X and baby boomers, by contrast, hold significant home equity and, often, ultra-low mortgage rates from prior refinancing. They have less urgency to move, which contributes to low resale inventory. In fact, older generations are increasingly aging in place or downsizing only gradually, limiting the turnover of existing family homes. Meanwhile, migration trends continue to shape regional housing markets. The pandemic-era shift of households towards Sun Belt and suburban areas persists, though at a slower pace, sustaining demand for housing in those regions. Lifestyle shifts, such as permanent remote work and preferences for more space, also remain factors in where and what types of housing people choose. Over the long term, experts anticipate that generational transitions, such as baby boomers eventually selling homes, will release more supply onto the market, but for 2026 the dominance of locked-in older homeowners is contributing to tight conditions and shaping the trajectory of the housing recovery. Three, mortgage rates, credit markets, and lending trends. The mortgage and real estate finance markets have entered 2026 in a phase of relative stability following the rapid interest rate increases of 2022 to 2023. 30-year fixed mortgage rates in the U.S. have settled around the mid-6% range after peaking above 7% in late 2022, and consensus forecasts foresee average mortgage rates near 6.3% for 2026. This leveling off is partly due to the Federal Reserve's slowed pace of tightening and hints of potential rate cuts as inflation gradually cooled. Markets expect only 1 or 2 0.25% rate reductions in 2026, reflecting caution until price stability is assured. Long-term bond yields, which heavily influence mortgage rates, remain elevated but have calmed from their 2022 to 2023 highs. Many industry observers believe steady, predictable mortgage rates around current levels could help the housing market by reducing uncertainty for buyers and builders. Mortgage credit availability and lending volumes are also in transition. With higher rates and stricter bank lending standards through 2023, some borrowers struggled to secure loans, but conditions show signs of gradual improvement as markets adjust to the new normal. Commercial and multifamily real estate lending surged 52% year-over-year in Q1 2026, driven in large part by a wave of maturing loans being refinanced from the low-rate era. Lenders and borrowers have been eager to restructure debt, taking advantage of even slight dips in rates to lock in financing. However, concerns over credit quality persist in certain property segments. The troubled office sector is seeing rising mortgage delinquencies, as values have fallen and some landlords struggle with refinancing. Office loan delinquency jumped by 0.74 percentage points to 11.41% from December to March in one index, reflecting the mounting financial stress in that segment. In the broader financial landscape, inflation and global risk sentiment are key drivers for mortgage rates going forward. Because mortgage costs are tied more closely to the 10-year Treasury yield than the Fed's short-term rate, market expectations about inflation, economic growth, and global stability are crucial. An oil shock in Q1 2026 demonstrated that even when the Fed holds steady or eases, mortgage rates can remain elevated if bond investors expect inflation to stay above target. On the bright side, the spread between 30-year mortgage rates and 10-year Treasury yields, which had widened significantly in 2022 to 2023 due to volatility and risk, has narrowed toward historical norms by early 2026. That compressed spread is a major reason mortgage rates have settled near 6%, even before any substantial Fed rate cuts. Reduced rate volatility provides some relief to borrowers. While mortgage rates may not fall dramatically this year, a stable rate environment allows buyers and developers to plan with more certainty, setting the stage for a gradual rebound in housing as affordability improves. Key developments in mortgage and lending. Federal Reserve and monetary policy. The Federal Reserve's cautious stance is a cornerstone of the current lending climate. Having raised short-term rates sharply in 2022 to 2023 to combat inflation, the Fed in late 2025 implemented a quarter-point rate cut, its first in 9 months, signaling a shift to a more supportive policy as price pressures tentatively receded. Entering 2026, the Fed and other central banks are holding rates steady. Some observers anticipate minor cuts if inflation consistently eases, though central bankers remain wary of moving too quickly. This careful balancing act, weighing inflation risks against growth concerns, means interest rates in 2026 are more likely to remain flat or ease slightly rather than drop to pre-2022 levels. For real estate, monetary stability is almost as beneficial as outright rate cuts, since predictability encourages market participants to engage, whereas abrupt rate swings can freeze activity. Stable mortgage rates and refinancing. Mortgage rates have plateaued around the mid-6% mark, which is a relief after the wild swings of the previous 2 years. In December 2022, 30-year mortgage rates peaked above 7%, but by 2026 they are hovering near 6.3%, and many forecasters expect them to stay in the 6% range through year-end. While these rates are high relative to recent history, their stability is giving buyers and refinancers time to adjust budgets and expectations. Homeowners and investors are seizing fleeting rate dips to refinance. Indeed, the big 52% jump in Q1 2026 commercial and multifamily lending was largely fueled by borrowers refinancing debt that was coming due. Refi activity remains below 2020 to 2021 levels, when rates were in the 3% range, but any sustained dip into the low 6% or high 5% range could spark additional refinance waves from homeowners still carrying loans above 7%. Meanwhile, mortgage application volumes have seen modest upticks in early 2026 as prospective buyers gain confidence that rates have at least stopped rising. Credit availability and lender sentiment. Credit conditions in real estate are in a state of cautious normalization. Banks, especially regional and community banks, tightened lending standards for commercial real estate in 2023 after a series of market shocks, including interest rate hikes and bank failures. In 2026, some of that caution lingers, but non-bank lenders and private funds have stepped in aggressively, particularly in the U.S., to fill financing gaps for viable projects. Debt funds and insurance companies are providing bridge and mezzanine loans, albeit at higher costs, for borrowers who might have struggled to obtain traditional bank financing. On the residential side, mortgage credit availability remains below pre-pandemic levels, with stringent requirements for down payments and credit scores, but there are signs of easing as competition for borrowers returns. Government-backed loan programs, FHA, VA, still play a crucial role in supporting first-time and low-income buyers. In summary, the cost of capital is higher, but financing is available for well-qualified projects and buyers. Creative structures and alternate lenders are ensuring most deals with sound fundamentals can still find funding. Loan performance and market stress. The historically rapid run-up in interest rates has led to rising stress in certain loan segments, notably for office buildings. As property valuations adjust downward, some highly leveraged office owners are handing back the keys, leading to a growing pipeline of distressed sales and an increase in commercial mortgage delinquencies. For example, one index shows the delinquency rate on office commercial mortgage-backed securities, CMBS, jumped to 11.4% in Q1 2026, up from 10.7% 3 months earlier. Retail and hospitality loans have also seen slight upticks in late payments, though overall delinquency rates remain low outside office. On the residential side, mortgage delinquency rates are near record lows thanks to a strong job market and prudent underwriting in recent years. Foreclosure activity has ticked up from the artificially low levels of the pandemic moratorium period, but is still below historical averages. Lenders are closely monitoring segments such as smaller regional banks and credit unions, which have sizable exposure to commercial real estate loans. Regulators have also flagged this as a potential risk area. There's broad recognition that managing and resolving troubled loans in a systematic way is vital to prevent credit issues from spilling over into a wider credit crunch. Inflation expectations and mortgage spreads. Inflation trends and investor sentiment are crucial for the next direction of mortgage rates. Mortgage rates draw from 10-year Treasury yields, which themselves reflect market forecasts for inflation and growth, plus a risk premium or spread. In late 2025 and early 2026, The spread between the 30-year mortgage and the 10-year Treasury yield shrank back closer to normal levels, around 170 basis points, after ballooning to roughly 300 BPS in 2022. This narrowing spread indicates improved market function and lower perceived risk in mortgage lending, and it has contributed to keeping mortgage rates around 6% even as the Fed's policy rate remained higher. For further significant declines in mortgage rates, inflation expectations will need to markedly improve, convincing bond investors to accept lower yields. As long as inflation is projected to gradually moderate, most forecasters see mortgage rates hovering near current levels across 2026. Yet any major surprises in inflation, e.g. due to commodity shocks or fiscal stimulus, could widen mortgage spreads again, since bonds hate inflation risk and demand extra yield to compensate. Thus, much of the housing market's fate is tied to macroeconomic indicators like inflation and employment that guide the bond market and, in turn, mortgage rates. Commercial real estate lending. A notable feature of the 2026 landscape is the bifurcation in commercial real estate, CRE, lending. On one hand, many banks have pulled back on new CRE loans, especially for office properties, due to regulatory pressure and concerns about asset quality. On the other hand, well-capitalized investors and alternative lenders are seeing opportunity in real estate debt. Private credit funds have raised significant capital targeting CRE debt, seeking to lend at higher yields and fill the void left by banks. Additionally, life insurance companies and agency lenders, like Fannie Mae/Freddie Mac, remain active in financing sectors such as multifamily, where fundamentals are better. The result is a two-tier market. Prime borrowers with strong assets can access debt financing, albeit at higher interest cost, while marginal projects or those in distressed sectors may struggle to find funding or face stiff terms. Loan-to-value ratios are generally lower than before, and interest coverage requirements are stricter. Despite these challenges, transaction activity in Q1 2026 was robust, proving that capital is indeed available for deals under the right conditions. For example, single-asset office sales totaled $11.5 billion in Q1 2026, up 40% from a year prior, as opportunistic investors and lenders struck deals at new pricing levels. Market participants expect that as interest rates stabilize or decline, more lenders will re-enter the market, potentially easing terms for qualified borrowers. Foreign exchange and cross-border capital. Another factor in real estate finance is the global currency environment and cross-border capital flows. The strong US dollar in 2022 to 2023 made American properties pricier for foreign investors, contributing to a drop in overseas investment in US real estate. In early 2026, the dollar has eased slightly from its highs, making US assets a bit more affordable to foreigners. At the same time, geopolitical stability or instability shifts capital flows. For instance, global investors from Europe and Asia have maintained or increased allocations to U.S. real estate in search of stable returns and as a hedge against domestic uncertainties. Middle Eastern and Canadian investors remain active in North America, while capital from Asia, e.g., Singaporean and South Korean funds, continues to target both regional and global property opportunities. Foreign direct investment into real estate is also influenced by policy. Changes like Section 899, a proposed U.S. tax on foreign investors in real estate that was not enacted in 2025 can affect sentiment. Overall, cross-border real estate investment remains significant, and currency movements plus relative interest rates will play a role in where this capital flows in 2026. 4. Office real estate. Challenges in a hybrid work era. The office real estate sector continues to face significant headwinds from high vacancies and secular shifts in work patterns. Nationwide, the office vacancy rate remains elevated at roughly one-fifth of total inventory. In March 2026, the U.S. average office vacancy was 17.8%, a modest improvement, 210 basis points, from record highs a year earlier. This follows 3 consecutive quarters of positive net absorption. As of Q1 2026, companies collectively added about 3.5 million square feet of occupied office space, halting the steep decline seen in 2020 to 2022. Leasing demand is gradually recovering. Q1 2026 office leasing volume was up 3.7% year-over-year, and some major markets like New York and San Francisco posted significant occupancy gains as firms consolidated into prime locations. Top-tier, amenity-rich offices in desirable submarkets are capturing much of this activity, even achieving modest rent increases, 0.8% YOY nationally, with standouts such as Miami, plus 4.0%, and New York, plus 2.2%, seeing stronger rent growth. Nevertheless, overall office utilization remains far below pre-pandemic norms due to the enduring prevalence of hybrid and remote work. Physical office occupancy in the U.S. has hovered around 50% of pre-2020 levels, as many employees continue working from home, at least part-time, despite widespread corporate return-to-office efforts. Employers are increasingly embracing flexible layouts and co-working strategies to optimize space usage in this new reality. Meanwhile, the flight to quality trend has left older, commodity office buildings struggling with very high vacancy rates and declining rents, as tenants favor newer or renovated buildings with superior ventilation, design, and amenities. This divergence is stark in data. For example, gateway cities like San Francisco and Manhattan still have vacancy rates near 13% to 23%, depending on submarket. But lower quality buildings in certain downtowns can have vacancy levels 2 to 3 times higher. Office property values have declined to reflect these realities, and the sector has been the weakest performer among REITs. In Q1 2026, the office REIT index returned minus 12.8%, hitting its lowest point since 2009, with multiple office-focused companies' shares falling double digits. Investors are wary of the sector's uncertain future. Some speculate that permanent remote work and AI-driven productivity gains may reduce the long-term need for office space in certain industries. The sector's pain is also evident in the rise of distressed asset sales and foreclosures. Even prime office owners in cities like Los Angeles and Houston have defaulted on loans or surrendered buildings amid untenable vacancies and high debt costs. New office construction has virtually stalled, with Q1 2026 completions at their third lowest level on record and the pipeline of office projects under development, 22.3 million square feet nationally, at an all-time low as developers shy away from adding supply. Adaptive reuse is emerging as a potential solution. Some cities are actively converting outdated office buildings into apartments or mixed-use spaces to revitalize downtowns and reduce office surplus. Local governments are also exploring incentives to repurpose vacant offices, seeing it as an opportunity to address housing shortages and breathe new life into business districts. In sum, 2020 SIX's office landscape is defined by transformation and uncertainty, with the sector in the midst of a painful adjustment to the hybrid work era, even as pockets of the market start to stabilize or find new purpose. High vacancy and hybrid work. Office vacancies remain historically high, a direct outcome of the shift to remote and hybrid work. The national office vacancy rate is roughly 17.8% as of March 2026, a slight improvement from its pandemic-era peak, but still about double the pre-2020 level. On average, only half of employees are in the office at any given time, as 52% of remote-capable U.S. workers are now in hybrid arrangements, and about 22% work fully remotely. Even with many big companies mandating a return to in-person work, actual office attendance has plateaued around 50% of pre-COVID norms, with a recent survey showing that 61% of employers have in-office requirements, but only 37% strictly enforce them. This enduring hybrid model is forcing a rethink of office space needs. Occupiers are downsizing, subleasing excess space, or consolidating into higher quality buildings, leaving older or less flexible offices with soaring vacancy. The national vacancy masks wide variation. Tech-centric cities like San Francisco and Seattle have vacancies in the 20% to 25% range, whereas markets like Miami are nearer 12% as demand remains robust and corporate migration continues. Flight to quality and rent trends. One response to the new normal is the flight to quality. Companies are moving into modern, amenity-rich offices to attract workers back, even if it means occupying less space. This has propelled leasing in top-tier buildings, which are often achieving stable or rising rents despite overall market softness. In contrast, Class B/C office properties are struggling to retain tenants and justify rents, leading to steep rent discounts and concessions in many cases. For example, national average office listing rents dipped 2% year-over-year by March 2026, but prime assets in New York, Miami, and Los Angeles saw rent growth, while older stock in cities like Portland and Austin had declines. Landlords of outdated offices are offering shorter lease terms, more flexible conditions, or even partnering with co-working providers to fill space, effectively moving their product closer to the co-working model. Additionally, with occupiers seeking flexibility, many new leases include options to reduce space later or expand only as needed. For forward-looking landlords, investing in office upgrades, better air filtration, collaborative spaces, smart building tech can help reposition assets to remain competitive in this environment. Office valuations and distress. The financial fallout of the office shakeup is visible in plunging valuations and rising distress. Appraisals for many office buildings have been marked down dramatically, especially in dense urban cores where remote work most affected demand. Office REITs have seen their stock prices slide as investors price in these changes. The sector's troubles dragged down an otherwise strong REIT market in early 2026. As mentioned, the office REIT index was minus 12.8% in Q1 2026, and several prominent office landlords have lost 20% to 40% of their market value in a year. On the ground, this is translating to debt defaults and distressed sales. In some cities, half-empty towers are being sold at fractions of their pre-pandemic prices, as owners and lenders seek to cut their losses. Delinquency rates on office mortgages have climbed, reaching over 11% in Q1 for securitized loans. Real estate observers say 2023 to 2025 probably represents the cyclical trough for the office sector, with many weaker buildings changing hands or being repurposed at lower values. While these adjustments are painful in the short run, they could set the stage for a healthier and more appropriately sized office market in the longer run. Investors looking at the office sector in 2026 are thus focusing on distress opportunities and conversion projects as much as traditional leasing income. Adaptive reuse and policy responses. Facing unprecedented vacancy and obsolescence, cities and developers are increasingly turning to adaptive reuse of office properties. Converting offices to apartments, hotels, or other uses is becoming more common, especially for older buildings in downtown areas that may no longer be competitive for traditional office tenants. Cities like New York, Washington, D.C., and Calgary have launched programs to encourage such conversions by expediting permits or offering tax incentives, hoping to address both the oversupply of office space and the shortage of housing. Additionally, some local governments are considering zoning changes to allow residential use in former commercial zones, smoothing the path for developers to make underused office buildings into mixed-income housing, student dorms, or senior living communities. These efforts, while complex and not a panacea, could gradually reduce the office glut in certain markets and create new real estate value in the process. Policymakers are also exploring ways to support the office sector's recovery, for example, through improved transit, which can boost office appeal, or by locating government offices and services in underused commercial buildings. The office real estate crisis is forcing innovation and policy action in 2026 as stakeholders work to transform a challenge into opportunity. 5. Retail real estate. Resilience and transformation in consumer spaces. The retail real estate sector is experiencing a noteworthy resurgence following years of challenges and pandemic disruptions. Investor sentiment towards retail properties has improved markedly as valuations have undergone significant repricing, making the sector attractive again in many markets. For example, in the United Kingdom, retail was one of the best-performing property sectors in 2025, delivering 9.2% total returns by Q3 as rebounding consumer foot traffic and rent stabilization boosted values. This pattern extends to parts of the United States and Asia. Investors increasingly see opportunity in necessity-based retail, like grocery-anchored shopping centers and local strip malls, which have proven resilient and even thrived as shoppers return to physical stores. The post-pandemic retail landscape is marked by transformation and adaptation. The long period of underperformance, exacerbated by the e-commerce boom and pandemic closures, forced many retailers to streamline their footprints, close underperforming outlets, and reinvent store formats. These adjustments have improved the health of surviving retail centers by reducing oversupply and focusing on productive locations. Retailers expanding now are those offering experiential shopping or essential goods and services, and they are targeting prime locations where consumer demand remains strong. Open-air shopping centers have become a standout segment in the U.S., with community and neighborhood centers seeing their strongest valuations in a decade, a testament to the robust performance of necessity retail like grocery stores and home improvement that benefit from consistent local demand. While retail is on firmer ground, stakeholders are mindful of future obstacles. Limited new development in many areas, due to high construction costs and long permitting times, has kept supply in check, supporting occupancy and landlord leverage, but also potentially restricting retailer expansion. Investors remain selective, focusing on well-located centers with proven foot traffic and stable tenant mixes. The sector's recovery is thus nuanced. Some categories, like high-end malls, continue to face headwinds from e-commerce and changing consumer habits, whereas others, like discount stores and convenience retail, are in growth mode. All told, leaner operations and stabilized rent levels have positioned brick-and-mortar retail for modest gains in 2026, especially for formats that provide experience, convenience, or essential goods as part of an omnichannel strategy. Investment rebound in retail. Retail property investment is on the upswing after a prolonged slump. Global retail property transactions rose 7% in 2025 to $125 billion, indicating that investors are returning to the sector following its deep repricing during the pandemic downer. The story of retail's revival is partly one of value investing. Years of underperformance and store closures lowered prices and created opportunities to buy quality assets at discounts. Institutional investors have been cherry-picking retail portfolios with defensive characteristics, such as grocery-anchored centers that showed surprising resilience and quick recovery in foot traffic once pandemic restrictions eased. In the U.S., Q4 2025 saw a major deal where Bain Capital and 11 North Partners raised $1.6 billion for a joint venture targeting grocery-anchored centers, a vote of confidence in that subsegment's stability. The return of capital to retail is also evident in data. Global retail rents and valuations have largely bottomed out and begun rising again in many markets by late 2025. Evolving retail strategies. Retailers and landlords are adapting their strategies to a new era of integrated online and offline shopping. Omnichannel retail has come of age. Retailers now use physical stores not just for sales, but also for branding, customer service, and as distribution nodes, with features like buy online, pick up in store. This has renewed the importance of location quality. Retailers want stores in places that complement their e-commerce operations. Necessity-based retail, grocery, pharmacies, home goods, is particularly strong, as these stores serve everyday needs and often anchor neighborhood centers with steady traffic. On the other hand, experiential retail, such as entertainment venues and dining, is also contributing to the resurgence by drawing consumers offline for social experiences that online shopping can't replicate. Retail landlords are re-tenanting spaces with gyms, healthcare clinics, and service-oriented businesses to diversify beyond traditional apparel and department stores. These changes, many accelerated by the pandemic, are giving retail real estate a new lease on life with a blend of offerings that aligns more closely with modern consumer preferences. Rent and occupancy trends. Retail occupancy and rents have largely stabilized and, in some markets, are trending upward again. For example, prime retail rents in Europe were 11% above their pandemic-era lows by late 2025, indicating regained pricing power for landlords as demand returned. In the U.S., shopping center occupancies are healthy. especially in open-air and strip centers where vacancies in many markets have fallen below pre-pandemic levels due to a scarcity of new development and sustained retailer interest. Coastal and Sun Belt markets with strong population growth, Florida, Texas, are seeing rents rise as new entrants and expanding grocers, discounters, and restaurant chains compete for limited space. Regional malls, however, remain bifurcated. Top-tier, malls with luxury and experiential tenants are recovering strongly, while lower-tier malls continue to struggle with elevated vacancies and repurposing needs in the face of online competition. Retail's road ahead appears cautiously optimistic. It is no longer the market's pariah, but a selective, fundamentals-driven approach is crucial to navigate which retail assets are truly poised for sustained success. Adaptive reuse and mixed-use redevelopment. Similar to the office sector, adaptive reuse is playing a role in reviving underperforming retail real estate. Many dead malls and vacant big-box stores are being reimagined as mixed-use developments that include residential units, offices, or community facilities. For example, some suburban malls are adding apartments or educational campuses on site, turning them into mini communities rather than pure shopping destinations. In dense urban areas, high-street retail spaces left vacant by bankrupt chains are being taken over by fulfillment centers, pop-up shops, or even health clinics. These conversions help absorb excess retail space and align it with current demand. City planners are often supportive, as it revitalizes spaces that might otherwise become blighted. Additionally, retail landlords are embracing technology, from better analytics on shopper behavior to digital marketplaces to fill short-term vacancies, to modernize operations and make their centers more efficient. All these adjustments are part of retail's broader transformation towards a more resilient, multi-purpose real estate segment. 6. Industrial and logistics real estate. Sustained growth amid tight supply. The industrial and logistics real estate sector remains a standout performer in 2026, supported by booming e-commerce and corporate supply chain reconfiguration. Warehouse, distribution, and logistics facilities continue to see robust demand, with occupancy at or near record highs in many markets. In the U.S., the industrial space availability rate hit a historic low of 7.3% in Q1 2026, marking the 31st consecutive quarterly decrease in available space. This translates to over 92% occupancy in warehouses nationwide, an exceptionally tight market by historical standards. Demand for industrial space has consistently outpaced new supply. In Q1 2026, 42 million square feet of U.S. industrial space was absorbed, exceeding the 35 million square feet delivered and further depleting vacancies. Industrial rents are climbing steadily as a result of the supply-demand imbalance. Across major logistics hubs, rents have been rising year over year, with double-digit increases reported in some coastal gateway markets where space is at a premium. E-commerce and third-party logistics, 3PL, firms continue to expand aggressively to meet consumer expectations for fast delivery, driving fierce competition for modern warehouses near population centers and transport nodes. For example, in the tightest markets such as Southern California and Northern New Jersey, vacancy rates are well under 5%, and rent growth remains very strong. By late 2025, some prime West Coast submarkets were seeing 10% plus annual rent increases as tenants vied for scarce space. The outlook for industrial real estate is bullish, but not without nuances. New supply is finally ramping up. Developers have record square footage under construction, and by slowing down late in the cycle have likely avoided severe overbuilding. Cushman and Wakefield noted that industrial vacancy rates likely peaked in 2025 and are now leveling off, as demand holds strong and new supply gradually catches up. In some inland U.S. markets, a brief oversupply of mid-sized logistics facilities led to slight vacancy increases, but this is expected to be temporary as demand growth remains secularly high. Technological advancements are also reshaping the sector. Tenants are investing in warehouse automation, robotics, and AI to boost efficiency, and newer buildings often feature higher ceilings and advanced loading configurations to accommodate these systems. Additionally, sustainability has come to the forefront, with developers integrating solar panels, electric vehicle charging, and greener materials into warehouses to meet environmental targets and reduce operating costs. Despite potential challenges like labor shortages in logistics and rising land costs, the industrial real estate sector is widely seen as having strong structural tailwinds, being essential to the modern economy's supply chain and thus likely to maintain high occupancy and rent resilience through 2026. E-commerce demand and tight supply. E-commerce growth continues to supercharge warehouse demand. The rapid expansion of online retail, accelerated by pandemic-era behavioral shifts, has dramatically increased requirements for fulfillment centers and last-mile delivery hubs. Many major retailers now maintain larger inventories closer to consumers to enable faster shipping, adopting just-in-case inventory strategies that require more warehouse space, not less. As a result, the U.S. industrial market has faced persistent undersupply. The national warehouse availability rate fell to just 7.3% in Q1 2026, the lowest in decades, indicating severe tightness well below the 10% threshold considered a fully occupied market. New construction has ramped up. Developers delivered a significant amount of space in 2025, and more is underway, but demand still outstrips new supply, sustaining upward pressure on rents and pre-leasing of projects long before completion. Rental rates and investor interest. The imbalance of supply and demand in industrial real estate has led to soaring rents and values. By late 2025, industrial rents were climbing by mid to high single digits on average, with some coastal and large metropolitan markets seeing annual rent growth above 10%. This rent inflation, combined with the sector's stable occupancies, has drawn investor enthusiasm. Industrial properties turned in strong returns in 2025, with many industrial and logistics-focused REITs significantly outperforming other sectors. For instance, the self-storage REIT subindex was up 9.2% in Q1 2026, among the best REIT performers. Investors regard warehouses as a solid long-term bet because of continued e-commerce growth and a limited supply of developable land near big cities. Some concerns have emerged about future oversupply in certain markets. but experts note that developers and capital providers are already showing restraint in new projects. The widespread belief is that industrial real estate has entered a new normal of high utilization, where even a moderate easing of demand would still leave the sector historically tight. Supply chain strategies and resilience. The industrial sector's growth is tied to larger trends in global supply chain management. Companies are diversifying and reshoring parts of their supply chains to protect against disruptions, a lesson from the pandemic. This creates demand for additional distribution nodes. Moreover, businesses across industries are focusing on logistics optimization, using warehouses not only for storage, but also as high-tech processing centers where goods are sorted, packaged, and sometimes manufactured or customized for final delivery. Modern warehouses increasingly feature state-of-the-art automation. Robotics handle repetitive tasks, and AI-driven inventory systems optimize space and routing. While these technologies reduce the need for labor per square foot, overall labor demand in logistics remains high, contributing to wage growth and a push for efficiency solutions. Another driver is 3PL growth. As more companies outsource their logistics to specialized firms, those 3PL providers are expanding their warehouse footprints. The cumulative effect is that industrial real estate stands firmly at the intersection of technology, consumer behavior, and global trade patterns, ensuring it remains a critical segment of the overall real estate market. Sustainability and challenges. Despite its strength, the industrial sector has its challenges. Rising construction costs and land scarcity are making it harder to build new warehouses in the places they're needed most. Urban and coastal markets often have limited land and community opposition to large industrial complexes, resulting in creative solutions like multi-story warehouses in high-density areas, a trend seen in cities like Seattle, New York, and London. Labor issues, shortages of truck drivers and warehouse workers, persist, pushing companies to further automate and raising operational costs. Environmental impact is another focus. Warehouses can be energy-intensive, especially cold storage and data centers, and contribute to sprawl, so there's growing pressure to improve their sustainability. For instance, green building certifications and solar panel installations are becoming commonplace for new major logistics developments, and companies are exploring electric fleets and better insulation to reduce emissions. These headwinds are being actively addressed because the sector's core fundamentals remain rock solid, and stakeholders are invested in ensuring its continued success. 7. Construction and development. Builders navigate higher costs and supply needs. The construction and development side of real estate is gradually picking up as demand stabilizes, but builders remain cautious due to persistently high costs and regulatory hurdles. Homebuilding activity is modestly rising. Single-family housing starts are forecast to increase 3.1% in 2026 to about 1.0 million units, slightly above 2025's total. Builders are responding to some improvement in buyer demand and the multi-year backlog of housing needs after a prolonged period of underbuilding. However, builder confidence remains subdued. The NAB/Wells Fargo Housing Market Index, which measures U.S. homebuilder sentiment, was 38 in March 2026, up slightly from recent months, but still well below the neutral level of 50, reflecting ongoing concerns over affordability and construction costs. By April 2026, the index had edged down to 34, its lowest since late 2025, as builders reacted to renewed inflation in material costs and uncertainty around interest rates. Cost pressures and supply-side challenges continue to weigh on development. Building material prices, from lumber to concrete, remain elevated after the supply chain disruptions of the last few years, and tariffs on key materials like steel and lumber are still in place, keeping costs high. Even though pandemic-era bottlenecks have eased, construction costs are significantly above pre-2020 levels, eroding builder profit margins. Additionally, labor shortages in skilled trades persist, forcing builders to pay higher wages and sometimes delaying projects. These factors have resulted in slower-than-desired home construction in many markets, contributing to the prolonged deficit of housing supply and keeping upward pressure on prices and rents. Policy efforts are underway to boost construction and alleviate the housing shortage. The federal government and some states are pursuing measures such as zoning reforms to allow higher density housing in certain areas and incentives for affordable housing construction. One promising development is the creation of programs to convert vacant commercial real estate, e.g., offices, into residential use, potentially adding significant housing units in supply-constrained cities. Builders themselves are adapting by shifting toward lower-cost markets and leveraging new technologies. Modular construction and 3D printing are slowly gaining traction as ways to build more efficiently and reduce waste. Some builders are also offering buyer incentives, like mortgage rate buydowns and price concessions, to help buyers manage higher borrowing costs and to keep sales moving. Home builder sentiment and activity. U.S. home builder sentiment is lukewarm, reflecting the challenges of 2026. The NAB Housing Market Index stood at 38 in March and dipped to 34 in April, indicating that more builders still see conditions as poor rather than good. Builders cite affordability concerns. Higher mortgage rates limit buyers' budgets, requiring price cuts or incentives, which combined with high input costs, squeeze builder margins. Nonetheless, housing starts are slowly increasing. Single-family home building is projected to rise slightly, around plus 3%, in 2026, as large public builders ramp up production of entry-level homes to meet considerable demand. Some home builders have reported that sales have improved in early 2026 compared to late 2025, especially when they offer incentives like temporary rate buydowns or free upgrades to help buyers overcome payment concerns. The multifamily construction pipeline also remains robust after a decade of growth, though new apartment starts may moderate from 2022 to 2023 peaks due to rising financing costs and local saturation in some markets. Materials, labor, and costs. High construction costs are a persistent headwind. Tariffs and supply chain issues have kept the prices of key materials like lumber, steel, and concrete elevated. Although lumber prices have come down from their extreme highs of 2021, other costs, such as labor, land, and regulatory compliance, have not abated. Many developers report 20% to 30% higher construction costs today than pre-pandemic norms, severely straining project feasibility unless rents or sale prices are correspondingly higher. Labor shortages are especially acute in construction. Unemployment in construction trades is low, older skilled workers are retiring, and there's stiff competition for labor from infrastructure and industrial projects. To cope, builders are investing in labor-saving technologies and prefabrication methods, and some are stretching project timelines or scaling back specs to control costs. The net effect is that new housing, especially at the affordable end, remains challenging to produce profitably, prolonging the supply-demand imbalance. Regulatory and zoning reforms. Addressing the construction shortfall requires tackling regulatory barriers. Many localities have strict zoning rules that limit the production of dense housing. For example, large areas are zoned exclusively for single-family homes. Recognizing this, several states, like California, Oregon, and Utah, enacted laws in recent years to ease zoning and permit accessory dwelling units, ADUs, or small multifamily buildings in more neighborhoods. Federally, the 21st Century Road to Housing Act aims to encourage local zoning reform by tying infrastructure and housing funds to pro-housing policies, and to allocate resources for streamlining permitting and supporting affordable housing development. There's also bipartisan discussion in Congress about expanding low-income housing tax credits, LIHTC, and other incentives to spur construction. These policy moves acknowledge that solving the housing shortage will require more building, and that means reducing red tape and adding carrots, and perhaps sticks, for local governments to promote housing growth, construction technology, and innovation. The construction industry has traditionally lagged in productivity growth, but 2026 is seeing increased use of technology to build faster and cheaper. Modular construction, where components are built in factories and assembled on site, is being used for everything from single-family homes to hotels and even some high-rise projects. This approach can cut construction time by 20 to 50% and improve quality control, though it requires upfront investment and supply chain coordination. 3D printed housing is another area with growing interest. Pilot projects in Texas and California are creating small homes via large-scale 3D printers, potentially reducing labor and material costs. Building information modeling, BIM, drones for site surveys, and exoskeletons for construction workers are among other technologies making building sites safer and more efficient. These innovations are not yet mainstream, but are gaining traction, especially as the industry grapples with labor shortages. By integrating technology, builders hope to deliver housing more cost-effectively, which could be key to relieving affordability pressures in the long run. Infrastructure and climate considerations. Construction activity in 2026 is also influenced by infrastructure investments and climate resilience. The 2021 Federal Infrastructure Law is still spurring projects to rebuild roads, bridges, and broadband. This not only puts pressure on labor and materials, contributing to costs, but also opens opportunities for transit-oriented development around new infrastructure. Additionally, climate change is a pressing factor. Builders in coastal or wildfire-prone areas face higher insurance costs and are increasingly required to incorporate resilience measures, e.g., elevating structures, using fire-resistant materials, or complying with stricter energy codes. Green building is no longer niche. More developers are striving for LEED or ENERGY STAR certifications to meet regulatory requirements and appeal to environmentally conscious investors and buyers. These evolving standards add cost, but also create long-term value through energy savings and future-proofing of assets. 8. Real estate investment trusts, REITs, performance. Real estate investment trusts, REITs, publicly traded companies that own and manage portfolios of properties, are showing solid performance in early 2026, reflecting the real estate sector's resilience. U.S. equity REITs outperformed the broader stock market in Q1 2026. The Dow Jones Equity All-REIT Index returned plus 3.8% for the quarter, even as the S&P 500 fell by 4.3%. This rally signals that investors have rotated back into REITs as interest rates steadied and the outlook for property cash flows improved. Over the prior year, REITs had significantly lagged stocks, with only a plus 3.4% return versus the S&P 500 17%. But now real estate equities are closing some of that gap. REIT performance is highly varied by sector, mirroring the dynamics in underlying property types. Industrial and retail-focused REITs are among the leaders. For example, a self-storage REIT subindex soared 9.2% in Q1 2026, reflecting sustained demand in that industry. Shopping center and warehouse REITs have also posted strong gains as investors bet on these sectors' bright prospects. In stark contrast, office REITs suffered big losses. The office REIT index plunged minus 12.8% in Q1, its lowest since 2009, with office owners comprising 7 of the 10 worst-performing REIT stocks over the period. Apartment REITs also dipped. The apartment index returned minus 7.6% in Q1 2026, due to worries about high new supply and rent deceleration. However, REIT fundamentals have been generally upbeat. Many REITs reported better-than-expected earnings in the latest quarter, with 16 of the top 23 REITs beating revenue estimates and raising full-year guidance for 2026. Occupancy and rent collection remain strong across most portfolios, barring the troubled office segment. M&A activity is also shaking up the REIT landscape. For instance, Peakstone Realty Trust stock jumped 46% after news broke that it would be acquired and taken private, highlighting investor appetite for undervalued real estate assets. Capital raising by REITs has picked up as well. After facing higher costs in 2022 to 2023, REITs are now finding windows to issue equity or debt at more reasonable terms given the improved market sentiment. Q1 2026 performance highlights. REITs had a strong start to 2026, with the broad REIT index returning plus 3.8% in Q1 and beating the S&P 500 by a wide margin. Investors rewarded sectors with positive tailwinds. Strip shopping center REITs gained 8.6% in Q1. Industrial/logistics REITs similarly had robust returns, and healthcare and self-storage REITs also outperformed as these segments saw solid fundamentals. On the downside, office REITs had double-digit negative returns for the quarter, reflecting persistent pessimism around office leasing and values. Market sentiment largely tracked the narrative of haves and have-nots in real estate. REITs owning properties in strong sectors, warehouses, retail centers, apartments in some regions, data centers, etc., fared well, while those concentrated in weak sectors, like CBD office, underperformed. Earnings and dividends. REIT earnings in late 2025 and early 2026 have mostly exceeded expectations, demonstrating that many sectors adapted well to the new economic environment. REITs in housing-related sectors, single-family rentals, apartments, reported steady rent growth and high occupancies. Industrial and infrastructure REITs logged strong same-store net operating income gains. Even some hospitality and retail REITs, which were hit hard in 2020, delivered upbeat results, benefiting from a surge in travel and consumer spending in 2022 to 2025. Perhaps most telling, numerous REITs increased their dividends in early 2026, confident in their cash flow outlook. For example, Diversified Healthcare Trust, DHC, saw its share price climb 37% in Q1 after reporting a 15.4% YoY jump in same-store net operating income and raising investor payouts. These positive fundamentals have helped narrow the gap between public and private real estate valuations, which had widened when REIT stocks sold off in 2022 to 2023. As of 2026, many investors view REITs as a bargain relative to private real estate, potentially setting the stage for further price appreciation if conditions continue to normalize. Sector rotation and strategy. One theme in REIT performance is sector rotation reflecting economic trends. Self-storage, manufactured housing, and certain specialty REITs, like data centers and cell towers, have proven defensive and growth-oriented, attracting investors in uncertain times. Conversely, sectors heavily dependent on return to office or urban recovery, some urban apartments, have lagged. This is leading some diversified REITs to rebalance their portfolios, selling less promising assets and reinvesting in stronger categories. In private markets, too, we're seeing a flight to quality. For instance, some mixed portfolios are shedding office buildings and instead acquiring industrial or residential properties, mirroring what's working for REITs. For REIT investors and managers, 2026 is about strategic focus. Many are doubling down on sectors with favorable demand drivers and exploring new avenues, like life science labs or self-storage facility expansions, to capture growth. Interest rates and REIT valuations. REIT valuations are highly sensitive to interest rate movements, so the stabilization of long-term rates has been a major boon. When rates spiked in 2022, REIT share prices plunged as investors discounted their future cash flows at higher rates. Now, with expectations of flattening or modestly declining rates in late 2025 and 2026, REITs are finding firmer footing. A big question is how quickly central banks will ease. Faster than expected rate cuts could provide further upside to REITs as their yields become more attractive relative to bonds. However, if inflation stays sticky and rates remain higher for longer, REITs could face renewed pressure. REIT debt management is also in focus. Most REITs have long-term debt locked in at low rates, but for those that need to refinance in 2026 to 2027, higher interest expenses could affect dividend coverage. Overall, the consensus among analysts is that REITs have likely passed their bottom, but further gains will hinge on continued economic stability and the path of interest rates. 9. Policy and regulatory developments impacting real estate. Policymakers at various levels are actively tackling real estate challenges in 2026, with significant actions on the housing, tax, and financial regulatory fronts. In March 2026, the U.S. Senate passed the bipartisan 21st Century Renewing Opportunity in the American Dream, ROAD, to Housing Act by an overwhelming 89-10 vote. This comprehensive housing legislation, which aligns with a similar House bill, aims to modernize federal housing programs and increase housing supply by streamlining regulations, incentivizing local zoning reforms, and directing more funding to affordable housing and infrastructure. Notably, the act includes a provision to temporarily restrict large institutional investors from buying single-family homes, defined as entities controlling 350-plus houses, with the goal of preventing big firms from outbidding individual homebuyers and driving up prices. This unprecedented measure would require certain investor landlords to divest any newly purchased single-family homes within 7 years, a controversial step reflecting growing concern that Wall Street ownership is exacerbating the housing shortage. At the state and local level, housing policy is evolving too. Several states, like Montana and Maine, have loosened zoning laws to encourage accessory dwelling units, ADUs, and small multifamily buildings in traditionally single-family neighborhoods. Others are experimenting with rent control expansions or anti-eviction measures to protect tenants, though these remain contentious due to fears they could deter new development. Local governments in high-cost cities are also using carrots and sticks. For example, Boston and San Francisco have streamlined permitting for affordable housing projects, and cities such as Minneapolis and Charlotte are revisiting parking mandates and density restrictions that hamper development. Meanwhile, urban planning efforts increasingly incorporate mixed-use and transit-oriented development, aiming to create more housing near jobs and transit lines. Financial regulation affecting real estate is tightening, especially regarding bank exposure to commercial real estate. Banking regulators in the U.S. are scrutinizing mid-sized banks for concentration in office loans and raising capital requirements to ensure resilience. Internationally, global regulatory bodies like the Basel Committee have updated guidelines to account for climate risks in real estate lending, potentially influencing how banks treat loans on properties in hazard-prone areas. Environmental regulations are another pressing domain. The European Union's Energy Performance of Buildings Directive, EPBD, is slated to require higher energy efficiency standards in buildings, pushing owners to retrofit older properties or risk obsolescence. In several U.S. cities, new ordinances, like New York's Local Law 97, will soon enforce strict emissions caps on large buildings, effectively adding a new operational cost for energy-inefficient properties. Tax policy is also a consideration. After mortgage interest rates soared, there have been calls to expand tax credits for homebuyers and affordable housing developers to offset costs. However, other proposals like changing the favorable 1031 exchange rules, which allow deferral of capital gains taxes on property sales, remain on hold. On a positive note for investors, Section 899, a proposed U.S. tax that would have increased levies on foreign investment in U.S. real estate, was not enacted in mid-2025, alleviating a potential dampener on cross-border capital flows. Taken together, 2020 SIX's policy environment is one of active engagement with real estate issues. The year could see meaningful legislation to boost housing supply and affordability, even as the industry navigates evolving financial and environmental regulations that will shape how and where development happens. Major U.S. housing legislation. The 21st Century Road to Housing Act is the most significant federal housing legislation in years. Passed by the Senate with broad bipartisan support, this bill aims to address the nation's housing affordability crisis through a variety of measures. It combines elements from multiple prior proposals, expanding funding for affordable housing, simplifying federal housing programs, and providing incentives for states and cities to relax restrictive zoning that hinders new construction. The House of Representatives passed a similar bill, the Housing for the 21st Century Act, overwhelmingly, and lawmakers are working to reconcile the two versions. Both emphasize modernizing housing programs, increasing supply, and aligning federal resources to encourage local pro-housing policies. If enacted, this law would represent a significant step in federal housing policy, one that acknowledges the depth of the affordability problems and the need for a comprehensive, multifaceted approach to increase housing opportunities. Institutional investor restrictions. One striking feature of the proposed housing legislation is Section 901, which temporarily bans large institutional investors from purchasing single-family homes except in limited circumstances. This measure stems from concern that corporate investors buying single-family houses, often to convert into rentals, are crowding out individual home buyers, especially first-time buyers, and driving up prices in some markets. The Act defines a large institutional investor as any for-profit entity that controls over 350 houses and would require such investors to sell any single-family homes they acquire within 7 years, with some exceptions. Proponents argue that this will preserve more entry-level homes for families to buy, but industry critics worry it could disrupt the build-to-rent sector, which has been adding much-needed new rental housing, and potentially dampen overall capital flows into housing. The debate highlights the tension between encouraging more supply, including rentals, often funded by institutional capital, and protecting homeownership access, especially for first-time buyers. The provision is temporary, sunsetting after 15 years, suggesting lawmakers view it as an experiment to stabilize prices and evaluate impacts. Zoning and local reforms. Beyond Washington, state and local reforms continue to shape housing production. California implemented a suite of laws, like SB 9 and SB 10 in 2021, that effectively ended exclusive single-family zoning in many areas, allowing duplexes and small multifamily on parcels previously limited to one home. Other states, including Oregon, Washington, and Massachusetts, have either passed or are considering similar moves to increase density and fast-track housing approvals. For instance, in April 2026, Montana passed a bipartisan housing package to override local zoning that blocks multi-unit housing in cities, reflecting a growing recognition that land use reform is key to easing housing shortages. Meanwhile, cities such as Minneapolis, which eliminated single-family-only zoning citywide, and Houston, which has long had no traditional zoning, are often held up as models for enabling more flexible development and more affordable housing options. The emphasis at all levels is shifting toward Yes in My Backyard, YMBY, policies to counteract NIMBY opposition and encourage a greater variety and quantity of housing. Housing affordability initiatives. Expanding affordability is a pressing goal in many jurisdictions in 2026. In addition to boosting supply, direct assistance to renters and buyers is on policymakers' agendas. Federal agencies are exploring down payment assistance programs to help first-time buyers overcome one of the biggest purchase hurdles. The Federal Housing Administration, FHA, has reduced insurance premiums on its loans to reduce costs for first-time homeowners, and Fannie Mae and Freddie Mac have introduced programs with more flexible underwriting for low to moderate-income borrowers. On the rental side, some cities are enhancing renter protections. For example, Portland and St. Paul have implemented or strengthened rent control measures, although the long-term impacts on housing supply remain debated. Additionally, organizations like NEMB, National Association of Mortgage Brokers, are pushing comprehensive frameworks to expand homeownership opportunities and address the housing affordability crisis through expanded financing options and subsidies. The convergence of these policy efforts reflects a broad acknowledgement that urgent action is needed to improve housing affordability, although their effectiveness will vary and often requires balancing complex trade-offs. Climate and resilience regulations. Environmental resilience is increasingly interwoven with real estate regulation. Governments are implementing measures to mitigate climate risks in the built environment, which can affect real estate operations and costs. In the European Union, impending rules would require upgrading existing buildings to meet more stringent energy efficiency standards. Otherwise, owners could face usage restrictions or fines. Similarly, in the U.S., cities like New York are set to enforce emissions limits on large buildings starting in 2024, e.g., the local Law 97 fines for emissions exceedance, pushing building owners to invest in energy retrofits to avoid penalties. These emerging rules mean sustainability is no longer optional for real estate. It's becoming legally mandated, with significant financial implications for noncompliance. In vulnerable coastal areas, stricter building codes and insurance reforms are being discussed to manage rising climate risks, such as flooding and hurricanes, which could affect land values and development patterns over time. Ten, emerging trends and technology in real estate. Technology and innovation, often dubbed PropTech, are rapidly transforming the real estate sector in 2026. The adoption of digital solutions and data-driven tools has become mainstream. For most large real estate firms, technology is now considered core infrastructure rather than an experiment. One notable trend is the rise of smart building systems. An industry survey indicates that by 2026, roughly 72% of large commercial portfolios use IoT-driven smart management systems for HVAC, lighting, security, etc., to optimize energy use and operations. Data analytics and AI are being harnessed for tasks from market forecasting to property management. For example, advanced algorithms can analyze millions of data points to predict which neighborhoods will see the fastest rent growth, guiding investment decisions. Virtual reality, VR, and augmented reality, AR, are increasingly used in property marketing, allowing potential buyers or tenants to tour spaces remotely in immersive 3D, which became valuable during the pandemic and remains popular for efficiency. Artificial intelligence, AI, is a particularly impactful development. Leading real estate platforms are deploying AI-powered valuation and search algorithms to improve accuracy and personalize results. For instance, Zillow unveiled an AI-driven home valuation model in early 2026, aiming to make its Zestimate estimates more accurate in dynamic markets and provide homeowners with real-time pricing insights. In commercial real estate, machine learning tools are being used to analyze building usage patterns and optimize leasing strategies. At the same time, blockchain technology is gaining a foothold in real estate transactions, with experiments in tokenizing property ownership that could allow fractional investing and faster, more secure property sales via digital tokens. Several major real estate firms are also exploring smart contracts on blockchain for property leasing and sales, which could streamline deals and reduce the need for intermediaries. Innovation also extends to physical real estate products. One example that grabbed headlines in 2026 is the Smart Lockbox Pro, a Bluetooth-enabled digital lockbox for home showings that went viral among realtors on social media. This device allows agents to grant secure, monitored access to a property via smartphone, improving convenience and safety for home tours. In construction, new green technologies, from energy-efficient materials to prefabricated modular building components, are making development faster and more sustainable. ESG, environmental, social, governance, considerations are now a major focus for investors and lenders, encouraging more widespread retrofitting for energy conservation and community benefits. AI and data analytics. AI-driven analytics are revolutionizing how real estate decisions are made. Companies large and small are using machine learning models to forecast market trends, identify undervalued properties, and even negotiate leases. In residential real estate, AI chatbots can answer buyer queries and schedule tours, while algorithms predict which households are likely to list their home for sale, enabling agents to target outreach. Most prominently, automated valuation models, AVMs, have become more sophisticated, as seen with Zillow's improved AI pricing tool designed to better track shifting market conditions. For investors, better data means more precise underwriting and potentially fewer surprises, though it also raises competition as everyone has access to similar insights. PropTech adoption. PropTech adoption surged during the pandemic and continues strong. Property management software, digital lease signing, and online tenant portals are now standard, minimizing physical contact and allowing for efficient operations. Landlords are increasingly leveraging IoT sensors and building management platforms to monitor energy usage, foot traffic, and maintenance needs in real time. This not only cuts costs, but also improves tenant experience, as issues can be addressed proactively. The combination of PropTech tools and human expertise is enabling a more responsive, efficient management of property assets, which is especially crucial as margins are squeezed by higher interest rates and expenses. Blockchain and tokenization. Blockchain technology is beginning to unlock new possibilities in real estate finance. Tokenization of real estate assets, converting property shares into digital tokens that can be easily traded, has moved from theory to practice in some pilot projects. A handful of early adopters are offering fractional ownership of commercial buildings via blockchain, potentially allowing smaller investors to participate in big deals and providing liquidity where there was none. While regulatory and technical hurdles remain and widespread adoption is still on the horizon, 2026 could see further experiments with real estate token offerings. Additionally, smart contracts on blockchains are being tested to automate parts of real estate transactions, like releasing funds from escrow when specified conditions are met, which could reduce closing times and paperwork. Many in the industry are watching these developments, balancing the promise of greater efficiency and liquidity with caution around security and regulation. Smart buildings and sustainability. Sustainability and smart technology are converging in real estate. Modern developments are equipped with advanced sensors and control systems to reduce energy waste, monitor environmental conditions, and even provide predictive maintenance of building systems. Cities are increasingly mandating energy benchmarking and carbon reduction plans for large buildings, as noted earlier with laws like Local Law 97, driving building owners to invest in technologies for efficiency. For example, major property managers report that smart building tech is now crucial for optimizing operations, from smart thermostats and LED lighting systems to elevator algorithms, all aimed at cutting costs and emissions. The PropTech market itself is booming. A 2026 report estimated the global PropTech market size at $54.7 billion, projected to more than triple by 2034, driven by AI, IoT, and smart city initiatives. This indicates how central technology has become to the future of real estate. Companies that embrace these tools stand to improve their competitiveness, while those that don't risk falling behind. YouTube video description, summary.